we thank everybody for joining our Community Bank Technology Strategy Information Session and Executive Roundtable. The goal of this session will be to share what we're seeing in the market, share what we're seeing in the opportunities and challenges for technology for community banks to compete both with the new banks, the non-banks, and the large banks. And as well, we'll be having 3 sessions, as we mentioned, over the next 3 months, where we'll be going deeper in each session to provide a lot of value. And so for that reason, we'll record this so that even those who didn't attend can obtain some value in a private, through a private link, so we can continue and increase the attendance for future as well. A diversity-owned firm brings about 100 years of experience in investment banking, management, and technology advisory, as well as civic advisory experience, all at major financial institutions, including 30-plus patents authored by our Chief Information Officer here, a decade plus of community bank advisory experience represented on our advisory board, as well as 50-plus years of inclusive housing and real estate experience, and 30-plus years of asset management experience. We're also an associate member of the AAA-CDFI, the African American Alliance of CDFI CEOs, which is an organization focused on how do we serve better our underbanked amongst private lenders. And so we're very focused on advising depository institutions as well as private lenders. And so we advise and manage investment assets on the behalf of nonprofits and for-profit organizations in order to help, as well as help municipalities in order to all innovate and form programs as well as investment funds around public-private impact investments. For more, we welcome you to see our website, and you'll see more of our leadership. But who we have on the call today speaking is myself, Mr. Yufani Jemia. I'm the CEO of Conscious Markets Group. My career over the last 12-plus years have been primarily in investment banking and asset management. Have had great experience advising all the way from and working on the executional side, all the way across from asset management to investment banking to private banking, to be able to know the inner workings of bank and wealth management operations. Furthermore, we have on the line Mr. Howard Anglin, who has been over the course of his career, 25-plus years at IBM. We mentioned over 30-plus patents authored, and has represented clients across almost all 7 continents in the world, especially banks ranging from large banks, and have seen how we can help with community banks to be able to compete with that sector, with that segment. And last but not least, Mr. Perry Weinstein. He's our banking strategist. He's an advisor to CMG, and he is, over the last decade, has been in investment banking, focused on the community bank sector, advising funds as well as community banks on strategy. So now I'll go ahead and pass it over to Mr. Howard Anglin.
Thanks, Jamie. And welcome, everyone. Great to have you here. And let's talk about technology and how we could leverage technology to transform the banking space. I'll not necessarily read through the entire quote here, but you can, as you can gather, digital transformation is important in today's banking space. You know, we're dealing with cybercrime. We're dealing with competition from non-banks, from fintechs, from startups who are acting like banks. So how can banks, especially community banks, with a budget not as hefty as the large institutions, compete and continue to serve their customers? So we'll get into that. Next slide, please.
Good. Mr. Perry.
Thank you. So as we know, scale is so important in many businesses, but it has been especially for banks. And the data does show, as you'll see, that larger banks often do perform better than smaller ones. But in order for community banks to, in this type of environment, to be able to compete, grow, and stay relevant, they will have to, deploy technology and software in all facets of the banks, which we'll get into later on.
Great. So let's talk more about technology and how technology can be a driving force to innovation for community banks. First, let's look at some strategic technology implementation. And we believe at Conscious Markets that community banks have a unique opportunity to leverage technology, not just as a cost center, but as a strategic differentiator that enhances the traditional relationship model. We can address areas such as the unbanked, the underbanked segments, and we can enhance our social responsibility and growth opportunity leveraging technology. So our technology investments, or the community bank's technology investments, should focus on efficiently serving these customers with digital solutions, not just digital solutions, but accessible digital solutions that maintain that personal touch that we're used to from or expect from community banks. So let's look at some areas, or let's just look at one example. For example, a data-driven customer engagement for banks. It's not just for big banks anymore. Community banks, need to necessarily join that bandwagon and utilize targeted analytics. And we'll talk some more about AI in a bit to deliver hyper-personalized experiences. This is quite key to engaging with the community, engaging with our customer base for these banks. Next slide, please. There are, of course, concerns whenever it comes to technology. First and foremost, let's talk about cybersecurity. And this is not just an IT issue. Cybersecurity is a business continuity imperative. So community banks need comprehensive risk management frameworks that account for some of the unique vulnerabilities that they may face, not just from a cybersecurity or physical security perspective, but an overall customer, client, and customer security basis. And as we implement some of these customer-centric technologies, we need to ensure that they're solving real problems. So we may get distracted by technologies, and let's pick a technology because it's the next shiny thing. We should look beyond that for our community banks. Rather than chasing technology needs, we should let's look at the challenges that internally the banks are facing, as well as challenges that our clients or customers to these banks are facing. And I think that's a good place to start. Again, we're going to talk some more about AI, but when evaluating some of the emerging technologies, AI is at the top of the list. We could talk about biometric authentication, for example, how we deal with our clients and leveraging some of these technologies. Open banking solutions, for example, for internal processes and systems and structures. We should prioritize these technologies that enhance the connections, not just internally, but the connections outside of the bank. So internal implementation as well as external implementation. Regulation. So how do we navigate some of the regulatory challenges when dealing with technology in the banking sector? So the regulatory landscape itself presents both challenges and opportunity. Again, AI, one of the latest technologies out that everybody's talking about, can be applied to regulations, for example, can be applied in unique ways to address some of the challenging, addressing some of the risk mitigation issues that we need to deal with regulatory, excuse me, pardon me there, from the changing risk standards that are presenting themselves as we progress through technology, innovation, technology, inclusion in what we're doing internally in our banks. Data privacy requirements are also creating additional complexity in the environment that requires proactive compliance strategies. And I believe that technology can help in that regard. So for community banks that actually view regulatory compliance as an innovation opportunity rather than a cost burden can actually turn that investment into competitive advantage, not just with our member community banks, but with the larger institutions as well. So we see tremendous opportunities in building technology bridges between institutional assets, regional banks, and with our customers as well.
Thank you, Howard.
Thanks. Thanks, Barry.
So let's talk about where we are and where the future of banking is going. I'd stress upon everyone that due to COVID, this has accelerated greatly, and that we are now in what the future of banking is going to look like, or soon to be. The traditional structures and cost structures are going to be very different. And in order to create a profitable and sustainable bank, technology and software is going to have to be deployed. Automation is changing how internal functions are used, how to gain customers, and that will be vital for any community bank, not only to grow, but also compete with the larger banks and perform necessary to remain its independence. The way I like to frame this is why I love community banks is that if community banks worry about their employees, their customers, and their communities, shareholders win. But in order to do so effectively, they need to possess the right technology and software. Next slide. Now I'm going to talk a little about productivity and a very underutilized productivity ratio. In banking, we hear about key performance indicators, and traditionally, we talk about efficiency ratio and overhead ratio. What's interesting is with efficiency ratio, it has to do with revenue. It doesn't really capture kind of the operating efficiency. And with overhead ratio, business models are completely different. A bank with a 2% NIM versus 3% NIM are completely different. It doesn't really capture profitability. This chart talks about net income as a percentage of compensation. The best banks have a ratio of over kind of 100%, meaning they create more money for shareholders than their employees. I think a good thing to think about is how to do this. It does take scale, but also very necessary to put the employees in the position to succeed, and giving them the right tools, software, and technology is extraordinarily important. Here quickly is the formula for it. Net income over salary and benefits is what I like to call banker productivity. This is something all management teams should track from a historical standpoint and kind of going forward to see how their profitability is improving. Banking, there's two kind of key performance, profitability indicators, ROA and ROTCE. I like ROA. And as this productivity ratio includes, the profitability and ROA of the bank will do so as well. I love this slide. So this shows some of the things that I previously talked about, how scale is vitally important, why there's community banks is a vastly kind of consolidating industry to kind of get scale. And this does show that larger banks have a higher net income as a percentage of salary, have a higher banker productivity. And the question that I like to think about is why. And yes, they have some built-in cost advantages, but I like to remind everyone this is just the average. There's some incredible community banks that are extremely profitable. And in order to do so, they have a niche and they deploy technology effectively in order to gain scale from a overhead standpoint, but also to focus on clients' needs. And the focus should be on, like I said, employee productivity, but also when thinking about technology is focusing on client needs and outcomes. Banks need to the frame of mind needs to focus on banks need to operate like businesses, and businesses talk about it in a bit, question things and think a little bit different and focus on competing. Next slide, please. So this is might be kind of the I like to call the game we play, and some kind of reality that I think every person in the bank industry needs to understand, especially if you're in management. So this graph clearly shows that over this 20 plus year period, the number of full-time employees have roughly stayed the same despite kind of the obvious massive number of branch closures. This is due for a number of reasons. One, regulatory compliance issues, but also because of the new technology, there are different roles that need to be filled. But even more importantly is the line that shows no matter what the banking environment is, the average salary of an employee continues to rise. And this is vitally to understand kind of the rules of the game. And management teams, in order to improve quality, need to understand this and need to understand this is going to continue to happen. So the question should be how, with this information, can we improve operations and profitability? And I would answer that is to focus on deploying technology so each employee, can operate at 20 or 50% better of efficiency, which is kind of vital in achieving operating leverage, essentially, as the bank scales through growth. Next slide, please.
Yeah, it's brilliantly said. And I think a big part of that is also we talk about, and from this perspective, jobs and things of that nature is, when your bank is operating efficiently, it puts you in a position to create jobs than if you're not operating efficiently and cannot expand and scale. So this is the end goal. Go ahead.
Yeah, well said. To kind of summarize Afani's point, if you're going to serve communities and their businesses, it would be good to lead by example and have a strong business. And that's what we're talking about here. And I think a strong community bank that's profitable with financial resources is actually able to give back to the community more, not less. So let's talk about kind of the goal and a number of key things that are vitally important that I've noticed in speaking with elite management teams from community banks. And I think it's important to understand that banks are risk managers, not risk avoiders. And those are completely kind of different things that you need to understand. And the characteristics that I've noticed in great management teams are they think differently. They think like a business. They're always looking to improve. They're always open to innovative ideas. And I think the way to summarize that is they're competitive. They're willing to compete, and they understand that in order to do so, often they need to find a niche and not serve everybody. It's focus on customers and clients that they can really add value to and be able to differentiate themselves from the pack. A good example of this would be a bank called Esquire. It's about under 2 billion asset bank where they focus on banking law firms and financing their litigation cases. And they produce a very strong ROA, great deposit base. But in order to be able to even do that, they have some of the best technology software and stack in the industry. And they've kind of grown off that and been able to scale very effectively. And to summarize, it is really on the CEO and the management teams of the bank to kind of drive innovation. In order to do so, you need to first start of kind of how to think about the process and set goals. Next slide. So we talked a lot about technology and how vital that is to improve employee productivity, fulfill clients' needs, connect with the community, and also produce shareholder value. But I think it's very important to understand how to do it and the characteristics. So banks trade off 3 multiples: profitability and growth are I would say fairly across industries. I think it's fairly easy to understand if a bank can grow EPS 10% a year consistently versus 6, they should garner a greater multiple. However, something that's overlooked that I kind of struggle with when I ask the question why is banks like CBU and Vivian that trade at very high multiples of earnings aren't really growing and high prices of tangible book value is the lack of volatility in earnings. This is a very cyclical industry, credit risk and interest rate risk. And you'll notice these banks are like rocks over 10, 20-year periods where you can really measure the core ROTCE and the standard deviation between each quarter. And they always have a kind of a very, very high ROTCE. And lastly, I think it's very important to understand why they have a high multiple, and that goes back to the characteristics: core deposits, pristine asset quality, and oftentimes they'll have kind of core fee income that doesn't possess the characteristics of interest rate and credit risk. And I think this is vitally important to help community banks kind of focus their attention on how to create value for shareholders, but also where to focus on using technology and software to improve the banks.
I think you talked a little bit about, core and fees and diversification from that perspective and sticky fee income at one point. And we talked a little bit about wealth management and things of that nature as well. And so there's also the technology across those divisions and how to build out the technology to support regulatorily and otherwise launching new lines of business as well as sticky lines of business. So that's something we'll go more into in next month's session as well. And so to kind of wrap up our overall themes that we kind of summarize here, number one, the best banks are focusing more on improved technology and software to service their needs and their client needs and to improve productivity as well as ensure regulatory compliance. And on the regulatory and security concern side, we're leveraging technology for better KYC, cybersecurity protection, data protection and fraud, as well as improving board standards. And we talked a little bit about leadership acumen today. And last but not least, something we didn't talk about much, but that we'll get more into in our next session, technology partnerships and what is the current influx landscape, as well as what are the current guidances that are being received and that should be considered with regards to technology partnerships and ways to create new product revenue opportunities. And so last but not least, customer engagement, digital tools to boost customer acquisition and retention, as well as, seeing the outcomes from all of the above of better results, revenues, and technologies that are a competitive advantage rather than just a cost center. And so what we specialize here in CMG is turning your technology budget into a competitive advantage. It aligns with everything that your chief technology officers or information officers may be working on, but bringing in the lens, to the strategy lens on top of that to really increase shareholder value. And so last but not least, we have case studies in our appendix, which we can go into a little bit today. But first, we would like to open up the floor to Q&A while we have some extra time here. Any questions can be entered into the chat, by the way.
Yeah, and before we get into the Q&A, if you don't mind, I think it's worth mentioning some of the implementation approaches for technology as it applies to banks in general and community banks especially. So for, I think a mobile first experience, that's no longer an option, that's expected. All our customers, I expect, mobile first when it comes to banking. And I've seen some of that in the responses. We had a survey out there, and I think most of the responses touched on that, that customer engagement from a mobile first approach. So our customers are expecting an increasingly seamless digital experience, not just from mobile only, but if you go on your desktop, it should be seamless as well. And we talked about automation or improving the processes. So process automation should focus on eliminating friction in customer interactions, which goes back to the mobile first approach. And Ifani talked about in the previous slide about technology vendors. And technology vendors should be evaluated not just on features, on what they can provide, features and buttons, but the ability to support unique compliance requirements, integration with existing infrastructure, and service the needs of the community-focused institutions. So focused on serving the needs of the banks. Thanks.
Brilliantly said. So yes, we're opening up the floor to any questions, and feel free to chat here. So I see one question here. To stay compliant, competitive, or it's not just about controlling data, it's about stewarding it responsibly in a changing regulatory landscape. Well said. And so the question here is, AI regulation is changing rapidly. Data governance standards have to evolve with them. Absolutely. Maybe you could put your name in the chat, iPhone 2. Thank you for that comment. Really great comment from the data governance perspective. Does anyone want to touch on that from CMG?
Yeah.
Yes.
Howard,
maybe.
Go
first, Harry?
Yeah. Let me go quickly, and then you can kind of get into the details of the technology. So I think this is a great question, and it's very important, and a lot of banks are working through this issue as we speak. And I think it's important to, when you say AI, to kind of differentiate the uses of AI, because they're used in many different forms, and to just say, AI is, risky or things like that doesn't give it fair justice. And from the people I've been talked to, I would kind of break it up into kind of three kind of categories. One being, if a person at the bank, was trying to, this is a simple, write an email, use AI to help, write an email, that's absolutely acceptable. The second one would be using the bank's information, right? Client information, their data, and using AI to format it, gain trends, but only AI basing off the data that they have, just a single function like that. But the third one is where the risk happens, where you have AI using, client and bank data, but then AI connecting to the greater type of, internet, and using all the knowledge that can possess. That's where the issue is from the people I'm speaking to. And something that is going to be regulated, and client files and protection. So I think banks are really focusing on that third option. Yes, there's a lot of, benefits to that. But I think they could also not get held up on that and kind of deploy it in other means. And some of the larger banks are doing so. And I think it's an interesting, bigger kind of question is, a lot of the larger banks don't focus on certain businesses because it's not worth their time. It's not really, worth the regulatory hurdle, mostly kind of small business customers. The question I'm thinking is, what happens if AI can make that, focusing on that profitability worth it for them? Like the downstream effect of, okay, if AI can do the compliance and make it worth a money center bank to do small business loans again, what's the downstream effect? And those are consequences I think community banks should be thinking about.
Well said, Howard.
Yeah, and it all boils down to data sovereignty. At the end of the day, banks need to protect, personal identifiable information. And in today's the direction that we're going with AI, leveraging models or AI models, and lately AI agents, how banks can get around that data sovereignty challenge is to, one way at least, is to leverage sovereign models, or models that are not there on the wider internet, but a AI model that's curated and managed by the institution itself. And it's not a difficult task, and it may sound complicated, but just think of it as a private instance of your AI that you can apply against your customer data. So all the same regulatory requirements that are there today would still apply. And you, in most cases, you're not, breaking any of those regulatory barriers that are not barriers, but controls that are in place to prevent that data from going out there in the wider internet or the wider information space.
Well said. Yeah, and I think a good example of this, and this is actually one of our case studies, is Synovus, right? Synovus have done Synovus Financial Corp have done a great job out in Georgia around AI implementation, and the case study was that their fraud detection improved by I think 15% of incidences or something like that. So just highlighting on they reduced their false positives in fraud detection rather by 15%, right? Mm-hmm. Excellent. So any other, I mean, emerging technologies, we can talk about that. That's kind of, we call that sort of like step 2.0 for banks, right? We kind of talk about first the internal efficiencies and then going external. Okay, Miles wrote, okay, Miles. Yeah, Miles. Okay, great to have your name. That's iPhone 2. So we will connect. And then, at other emerging technology, you can see banks implementing blockchain technology. Prosperity Bank, based in Houston, Texas, right? They did that, resulting in 25% decrease in their transaction processing times. They do a lot of interbank transfers. They're using it for interbank and cross-border transaction costs. And so there's different ways, but what we always suggest for banks is to set up their internal efficiencies, technologies that way, and then begin thinking also about new and developing technologies for the competing factors. And so that's one area where it's not we as an advisory team can help extend your budget and in order to be able to keep your pulse on that. So somebody else mentioned, can you address dynamic credit scoring in community using AI? Somebody want to talk about that?
No, Perry, do you want to touch on that?
I can try. I'm not quite. I think I know what they're hitting at dynamic credit scoring. I mean, I
think that's just referring to the systems that are currently being developed, right, Perry? You may have been aware of these and that are kind of alternative, such as like Isusu being used for the mortgage industry, alternative credit based on people's consistency in paying their rent, things of that nature. So there's definitely technologies that we've interviewed, we've due diligence for clients with regards to this. But go ahead, Perry and Howard.
Sure. I think it's important to one differentiate like business focusing commercial versus retail focus, and the kind of regulatory standards are quite different. We talked about mortgage, for example. There are a lot of banks that are getting out of the mortgage industry because just of the compliance that and the regulatory burden that it costs now, and with rates high, they're not getting the originations, things like that. And I think even before kind of AI, discovery is an example, or these personal kind of mortgages, they're always looking for, I guess, third-party data or additional information to score credit. And I would say that those are allowed. The issue would be is that they can't have any biases for all the things, the issues with, personal credit and things like that unfortunately plague the industry. I think that's really important. And then from a bank's regulatory standpoint, I would suggest that these banks have guidelines of how they use it, right? Kind of format strategy, rules and in place to show the regulators of kind of what this allowed to do and how it's doing.
And I'll actually turn off the recording here so that everybody can feel comfortable for more questions. And so we will wrap up the recording and look forward to the next one. And then let's wrap up with a few additional questions.
As Perry framed it, but for this dynamic credit scoring system, the assumption is that additional data sources or non-traditional data sources would necessarily be leveraged in order to come up with that conclusion. And that's where the risk lies, right? Pulling in data from non-regulated sources potentially, or alternate sources without the necessary regulatory framework around it. And the additional problem area arises when, once you pull that data in, like who owns that data, and are you exposing yourself as an institution as you open the aperture for that data to come inside your institution. So, those are some of the areas where, there could be risks, but, those of course could be mitigated. And, from the RegTech, I know we have RegTech listed here,